for investors in the gold and silver sector lately, as gold is trading near $700 and silver is below $10. Joining us today is Ted Butler, who writes for Investment Rarities. Ted, when you look at the metals market at this point from a commitment of traders perspective, where are we in terms of how the commercials are positioned?
Hey, Eric. Position fine. This is just the way that the commitment of traders structure works. The worse the price action, the more improved the structure, meaning that the more speculators are flushed out of the market and commercials are buying every contract they can, either to close out shorts in the case of the very biggest trader or traders, or smaller commercials going long. So we're at I'd say an extreme point that we rarely reach from a commitment of traders' point of view. No pain, no gain, and we sure have had a lot of pain, but in terms of commitment of traders, the gains are there too. It's configured spectacularly bullish.
When you look at the gold market, and there's no way to know when it would deteriorate on the upside, but what do you see in terms of what that means probably for the gold price in terms of an advance? What could we be looking at in terms of an advance?
Well, an advance can start at any time. I mean, the commitment of traders is not basically a timing indicator. You got to rely on more technically oriented measurements. But it tells you that we're in the region from which a significant gold rally can commence at any time. At that point, once we cross over significant moving averages, then we'll have to measure what deterioration, what commercial selling takes place, and what technical and technical fund buying takes place. That's what causes the deterioration. But I will point out, in gold and silver and now many other commodities, including oil and certainly base metals, the moving average, we're so far below the moving averages that we could see, particularly in silver and in gold, some dramatic price rallies before we'll even begin to start to measure whether there's a deterioration. For instance, right now, we're about at near the $700 mark on gold. We're about $200 below the 200-day moving average. We're close to $7 below the 200-day moving average in silver. These are numbers that have never been seen before. I mean, gold in the last 6 or 7 trading days has dropped $200. If you go back a month prior to that, we can see that almost in the same period of time, it rallied that same amount. The point being is that the way the market is configured right now from a commitment of traders' point of view and the extreme degree that we're sitting below critical moving averages, it is prime for hellacious rallies to the upside, and, we'll take it when we get back, which eventually we will, to the moving averages. We'll begin to measure the deterioration at that point, but the key, element here is that we could go a long way up in price before we even have to begin to worry about deterioration. It's set up for a dramatic price move from a commitment of traders and moving average point of view.
When you look at this commitment of traders, is it the most bullish you've ever seen, or have there been other times where it's...
Well, I mean, I can't say we haven't seen other times. I followed this thing for maybe 20 years, so you're going to find times that might appear comparable and just a straight comparison to the commitment of traders. But I will say this, putting the whole package together, what's going on in the real world with the economy and credit crisis and other markets, and the extreme degree of the sell-off that we've seen in the last couple of months, all those things taken together, and adding in the commitment of traders, I would say this is the most extreme buy point that I've seen. That doesn't mean necessarily that we can't go lower, but from a commitment of traders' point of view, the lower you go, if in fact we do go lower, it just improves the situation. It's not something that, oh my gosh, if it drops $20 from here in gold or another $1 in silver, not that I'm predicting it, but if it were to do that, it wouldn't change anything in the sense that disproving or having to call the commitment of traders invalid. It just makes it better. I mean, it's painful, no doubt about it, but this particular perspective or premise of the market, the more it goes against you, the better it is from the structural point of view.
Ted, you mentioned to me the other day that you had looked at the stockpiles of some of the base metals and noticed that they were just on a global basis at very low levels. And then at the same time, you had mentioned to me mines were having to be shut down and mines that were going to come online or are not going to be coming online. Where are we in terms of the metals mining stocks, in terms of production? What do you see and what type of impact will that have for silver?
We use the word unprecedented and extraordinary every other day in the current environment that we're in, but these are truly unprecedented and extraordinary times. And what I was mentioning is that normally in the base metal cycle, you'll generally see prices slipping below the cost of production after we've had a tremendous buildup in inventories. This is the law of supply and demand in the business cycle. Generally, we peak out in prices when inventories are very high, and because those inventories are very high and the price is generally high at that time, we kill off demand and encourage production, and that's what creates a surplus in the high inventories. And then we have to work the cycle the other way, and the inventories have to be whittled down. The price comes down, in some cases below the cost of production, and mines start to shut down, and we live off the inventories for a while. Then when we get to the bottom and there's no more inventories left, prices start to reflect that and come up, encouraging, more production, and the cycle's repeated. So generally speaking, we top out in prices and go below the cost of production when inventories are high. That's always been the case in the economic cycle since World War II. This time it's different. It's weird. We have relatively low inventory levels compared to the last 10 years. In copper and in lead and zinc, we're not at the dead bottom as far as inventories, but we're closer to the bottom than we are to the top when you step back and look at a 10-year perspective. So what's so unusual is that we've moved dramatically and quickly below the cost of production for all these metals, copper, lead, zinc, nickel, just about every commodity you can think of. We've moved sharply below the cost of production, which will, in time, if we stay here, affect, mine production. Mines will cut back, shut down, smelters will shut down, and it's happening now as we speak. And it may be accelerated due to the current unsettled condition of the world economy. But what's so weird about it is that we're below the cost of production dramatically and have moved there quickly while we have very relatively low inventory. So you've got to start considering what happens on the flip side. After mines start to adjust and shut down production, as they will at these prices, we don't have big inventories to fall back on. So if things play out the way it looks like it's going to play out, we could have a world recession and slowdown in industrial consumption, but because prices are below the cost of production already, and mines do limit production, curtail production, very quickly we can run into shortages of just about everything as this production falls and as these already relatively lean inventories are eaten up. We don't have any big inventories to eat into, so we could have this very unusual situation of being in subdued economic times, down over the next year or so, and at the same time have shortages pop up of everything because you just don't flip a switch and turn a mine on and off at will. We will go through the inventories that we have that are already lean very relatively quickly, and, recession or no recession, and if there's going to be some demand for all these resources, if they're not available, you could have very dramatic and volatile prices to the upside much quicker than people expect because of the low inventories.
As people begin to, because here's an article, I think, from the journal, Strapped Miners Delay Projects, but is there, Ted, shutting down some of these mines for the lead, which you said is happening right now, the lead, the zinc, et cetera, and silver's a byproduct, because we're having tremendous demand, are we not, for silver, and then as it comes out as a byproduct of these metals, what does the silver situation look like then?
Well, that's the punchline. I've never been accused of mincing words when it comes to silver, and I won't mince words now. I'm on the record as being exceptionally bullish or feeling silver could explode at any moment.